Hi, this is Randy Finney with Right Side of the Chart, and today is Sunday, September 16th, 2012. And tonight's market overview is sort of a follow-up to the global market overview video that I did back on August 4th. At that time, we took a look at a lot of the world, the key world indices, most of which were either right at or near approaching some key resistance levels, either downtrend lines or horizontal levels, or both, on the daily time frames. And although at that time I did expect prices to turn down based on my read on the markets, it proved I was wrong, and prices punched right up through there. We've had some very bullish technical price action since then. Yes, there was quite a bit of central bank intervention, but at the end of the day, I'm really a purist when it comes to charts, and I believe the charts are what they are. We had those breakouts. Price action is first and foremost always, and so the action has been bullish since. If you also recall from those videos, I highlighted that the possibility that if we did break out, then I was looking at some additional overhead resistance on the weekly and monthly charts. And for months now, I've also maintained that it has been the weekly and monthly charts, the longer term charts, that have been driving my overall investment process. There are times where I'm actively trading, even day trading. My primary style is a swing trader, and with the markets being where they're at now and everything I'll cover tonight, I still maintain an overall bearish bias, and I do think prices will turn down soon. If they don't, I plan to cover some go over a few strategies for those of you who are short, how to exit, for those of you who are bullish and long, how to enter, because prices, I think even the most bullish of bears will admit prices are getting pretty extended here in the short term. And there are still a lot of warning signs, non-confirmation signs on these breakouts, so might not be the best time to be positioned aggressively long or aggressively chasing new long side breakouts. But either way, again, as I mentioned back a few weeks ago, that if we did take out those daily resistance levels, that we would be looking at some additional supply or resistance overhead, namely on the weekly charts, and that's what we'll talk tonight. So let's go ahead and start. Let's go over to a daily frame and actually start overseas. We'll start there and end up in the US. We're looking at here the Paris CAC 40, and here's a daily chart, daily time frame. And what we're looking at here, I have this downtrend line drawn off the May. Let's see. Let's put the date in here. That's the May 2nd, 2011 highs. We've had several reactions off this trend line to help validate that trend line. And so back here, a couple weeks back, we had a nice clean breakout. I can't remember, but looking at the size of that candlestick, that was probably on some European central bank news. Either way, I don't follow the Paris CAC on a daily basis, but so from a technical point of view, clearly bullish action. Breakout, prices came back to retest, or a near retest. They didn't come all the way back to it, but came back to help work off those near-term overbought conditions, and then have moved up strongly. And that's where we are today. If you take a look at this horizontal line, prices are just up to that. That's right around the 3,600 level, give or take. And if you look at here, we have a previous reaction high at that line. Go back into 2010, we have this spike low here. So this is a pretty significant resistance level here, and with the CAC getting quite a bit overbought like most other indices right now, I would be very, very surprised to see it just punch on through there and continue on. What the bulls would like to see ideally would be for prices to either pull back here, come back in a little bit, maybe consolidate, work off these overbought conditions before making an attempt and a breakout of that level. In doing so, that would help increase the odds of any breakout above this level sticking and prices continuing to move higher. Let's take a look at the weekly time frame. So from the daily point of view, clearly bullish action. From the weekly point of view, we're looking at here a multi-year, and we're talking 5-year downtrend line that starts all the way back in the middle of 2007 at the bull market highs. And this looks like a pretty clean downtrend line, quite a few touches. Where we're at today, let's zoom in a little bit here. As you can see, prices have slightly punched through. They did close the week slightly above this downtrend line. Now, I'm not going to try to spin that as bearish. You call it bullish, but I would not consider the CAC 40 on breakout yet, at least not on these longer term time frames. Reason being, it is very common in trading on any time frame to see a trend line. If you take a look here, you can see that nice red candlestick wick or tail well below this trend line. Prices shot back down and then came back up. Here we have a move above that trend line. So until we see prices continue to move a little bit higher, stay above that line for some period of time, or move on through. And more importantly, we have this horizontal level. Again, this is the same level that I pointed out on the daily chart. You can see those reaction highs and lows here, and there's some back in 2009, 2010. Prices danced around that level. So this is an important level as well. So consider this a resistance zone here on the weekly chart. And I give a higher preference to these weekly time frames than I do the daily time frames, especially considering how overbought we are. I'll probably talk on that. That is the main theme. As those of you who follow the site know, I do a lot of long trades, a lot of long side breakouts, and trading. The key to deciding whether to go long on a downtrend line break is what's down here. From a pure price point of view, sure, if it was that easy, go long every time a downtrend line breaks out. However, on the setups that I post on the site, such as bullish falling wedges and other patterns, I have confirmation below on at least one, the more the better, these indicators. So we don't have any positive divergence in place. We did not have a divergent low here. All I can tell you right now is that we are looking at prices approaching overbought readings. And if you look at, what I'll do here is put the crosshairs on up top. If you look at price on just about every major correction, if you look down below, this is the RSI down here, you will see prices were at or near overbought levels, or had just recently come off overbought levels. So to try to put your odds in your favor, don't stay aggressively long when prices are overbought, and most importantly, I would be very skeptical right now of having a portfolio of heavy longs as prices approach key multi-year. Again, we're talking 5-year downtrend line resistance here as prices are reaching overbought levels. So maybe we do go up a little bit more, but statistically speaking, the odds favor a pretty significant pullback soon. And being that we're at key resistance right now, I don't think the risk reward to being aggressively long at this point is worth it. All right, let's fast forward and move along a little quicker here. And okay, London FTSE daily chart. We have a very clean downtrend line. If you can zoom in on the chart, or take a look at the chart. If you're looking at this video, you should be watching it in high definition for the best clarity, and on one of the large, or either a full screen or the large screen, large size player. And we can see here 1, 2, 3, now 4 perfect tags of that downtrend line. So this is a very valid downtrend line. Again, we're looking at a daily time frame. This downtrend line starts back in May of 2011, so we're looking at about a 1.5-year old downtrend line. And like most other indices right now, prices are approaching the overbought level. Sure, they could go higher. Overbought can stay overbought. But I'll talk a little bit more about the overbought readings right now when we get to the U.S. markets. So that's where the FTSE is. Here's the downtrend line to watch. Let's see what prices do. If they do get above this line, follow the horizontal line on my crosshairs, and you'll see here we have this previous reaction high from back on the middle of May, and that will also act as resistance for the FTSE. So we're at downtrend line resistance with horizontal resistance not too far overhead. Weekly time frame. Now this blue line, if you can make it out, I have it highlighted here. That's the daily downtrend line I just looked at. That goes back for about a year and a half. Now here is a much longer term, more significant downtrend line. This one stems back from July 13th, middle of July 2007. And that downtrend line, prices are right at that downtrend line now. We have multiple tags, 1, 2, 3, 4, at least 5, 6 different tags on that downtrend line. So again, for those who are only paying attention right now to the daily charts on a lot of these other indices, don't take your eye off these longer term charts. I'll speak a little bit more on that at the end, but I do think a lot of traders focus primarily on the daily charts, and I think that's a dangerous proposition, and it's likely increasing the odds of a bull trap quite a bit right now, as we have a lot of shorts covering in the last few weeks on these daily breakouts and all the Fed and European Central Bank action. So bottom line is Technical Analysis 101, buy support, sell resistance. And if these oscillators and indicators down here were confirming a breakout or indicating a breakout is likely, I would be looking, preparing to go long on a breakout here. However, like all these charts show, clear negative. I shouldn't look at this line. That's not a good case of negative divergence. This was negative divergence back here. We had prices made a higher high at this point, so that line should have been drawn to there. Over here we didn't make a higher high. That was a lower high. So either way, we do have the RSI lagging. Those are things to watch. These downtrend lines that I have drawn on the MACD and the RSI, in one case that might be bullish if we do break above these. So keep an eye on the FTSE. We may break out. Prices are going to meet resistance up here a little bit higher, and we do have some downtrend lines here. Let's see if prices turn down. Obviously these oscillators will turn down there as well and keep these looking a little bearish. Okay, finally let's look at the Frankfurt DAX index. Here's Germany. Let's jump over to a daily chart first. Again, nothing but bullish action on the daily time frames. If you take a look at this yellow orange downtrend line that I have, quite a clean looking downtrend line. Prices broke out, came back to retest. Yeah, they came a little bit lower, but that's normal, well within the range. Held and then powered up, and have been moving up very sharply since. So from a technical perspective, nothing but bullish action. This is these two lines here. Looks like we're in a nice rising channel, which we've just actually overthrown. So like a lot of the U.S. indices, which I'll talk on here in a minute, we've had some wedge overthrows, and we also have that here on the DAX on this channel. And it's been my experience that a lot of times when we have these overthrows or overshoots, that prices quickly and pretty sharply come back to within the pattern and very often go to break down the other side. So again, I'm on the lookout here for a possible bear trap. I remain positioned short. I am not going to give it a whole lot of room on the upside, and I'll talk on that later. Some exit plans or exit strategies for those of you who are also short. But at this point I remain bearish for now. So if the DAX manages to go a little higher and stay outside of that channel, these two horizontal lines here represent these prior reaction highs. So we still have that on the daily time frame, this level to clear before the DAX is really looking at blue skies. So still have some resistance not far overhead. Weekly chart on the DAX. Again, not to sound like a broken record, but here we are on another key global index, and we have a very well-defined multi-year downtrend line stemming all the way back to the 2007, highs. 1, 2, 3, 4, nearly 5, now 6 reactions on that line. So again, resistance is resistance until broken. So we're broken out on the daily charts, but we are right at key resistance levels on just about every global index here, and continue to urge caution. I still think the risk reward to being aggressively long here is just not worth it at this point in time. Maybe in a couple months, even a few weeks, prices hold up, and again I'll talk on that. We could see the technical picture develop a lot more bullish, but for the time being, that's where we're at. Okay, now fast forward. Now we're on the U.S. markets, and we're going to start with the S&P 500 here. And let's look at this yellow line here. That this is, although it is a trend line, there are a couple points there. I wouldn't consider that valid. This may continue to move up. But the point I'm trying to show here with this yellow line is, right now I only have the RSI. I'll add I'll put the MACD up here. But we continue to have a divergent high, meaning prices have made higher highs from back in the peak in late March, early April, and the current prices. So we have a significantly higher high. Price action has been bullish, but yet all the indicators and oscillators on just about every one that I follow, many which aren't here. I typically show the RSI and the MACD, and occasionally I'll look at some other ones, but prices on those have made lower highs, so we have negative divergence. Yes, this is only a slightly downsloping line. Even on some of these oscillators down below, we have pretty much flat lines. In other words, the highs are making equal highs peak to peak, and that's what's known as flat line divergence. It's still a form of negative divergence. If your prices are making higher highs, you want to see your oscillators making higher highs as well. So another reason I am very skeptical and cautious of this breakout. Price action wise, yes, technically, if you look at this downtrend line that I have highlighted here, this white downtrend line, prices broke out, came back down, and then powered up. And now let's take a look at these lines here. I'll color code these just to make it easier. Let's make these blue, and these blue lines show us a rising wedge, which we now have a wedge overthrow. I talked on that a minute ago. For years I've been trading these patterns, and from my experience, more often than not, again, nothing is 100% in technical analysis, but more often than not, when you have a wedge, whether it's a bullish rising wedge like this, or a bearish rising wedge like this, or a bullish falling wedge, when you have prices overshoot in the opposite direction that wedge is expected to break, very often you'll have them come back in very sharp and fast. And not only do they come back in the wedge, but they usually immediately or very shortly after break to the downside. So again, something to watch for. First things first, we need to see prices come back within this wedge. Secondly, to see a breakdown of that wedge. And then, of course, I'll go over some additional technical support levels that we need to violate, because I know the big question in everybody's mind right now, whether you're a bull, bear, or completely neutral right now, not knowing what to do, is what will differentiate a normal pullback. Even the most bullish bull right now realizes that the markets are getting very extended or overbought and need to pull back and will pull back at some point. But as a trader, we need to know, is this any pullback or consolidation? Is that a buying opportunity, or is that the beginning of a correction and a possible bull trap? And again, we'll go over that a little bit more here. So price action has been bullish. However, it's a breakout that I'm not chasing on the long side, and I'm remaining short because of these non-confirming, or actually these indicators which refute the bullish move here. And let's throw in the MACD. Let's shrink down this RSI. You almost have to stretch this MACD out so far since prices have fallen so low back here. But as you can see, we have negative divergence from this point on. I also added the yellow line here from this price high, this yellow line, and this yellow line down below. So clear negative divergence on the MACD. Now if prices do push up a lot higher, or much higher, we're going to burn through that divergence on pretty much all these indicators. I mean, the RSI won't stay overbought forever, but the MACD can continue to move higher. it's not bounded like the RSI or the like the RSI. So if we do see prices consolidate, maybe pull back and then power up, and we start to see the MACD come up here and make new highs over this level here, especially over this level. Obviously the market will be quite a bit higher by then, but that will sort of dissipate the bearish scenario, if you will. So negative divergence in itself is not a sell signal. It is more of a caution sign, or puts you on the lookout, especially when combined with a pattern like a bearish rising wedge. And let's jump over to the weekly chart here. Now, actually, before we go to the weekly chart, let's take one more look at the RSI. There's a pattern that I wanted to point out on the RSI, and I'm seeing this on a lot of the indices. It's what I refer to as, let's say, a double tap RSI pattern, or double tap overbought readings. A lot of times when prices reach overbought levels, we do have corrections, but there are times, like let's look at most recently here, we came very close to the 70 reading, just a hair below, and prices, yes, we did have a little bit of a pullback, but not much. If you notice, a lot of these major corrections, like we had here, back here, they started from right at or near shortly after overbought readings. And something I've noticed is very often when we get the first overbought reading, when we haven't had any overbought conditions in a while, like look at this, prices, the RSI stayed low for months. We came up, got overbought, pulled back to the 50 level, and then punched back up to hit the overbought level again, within a relatively short time period. That's what I call a double tap. Tap the 70 line, pull back to the 50, come up, hit the 70 line again. And that is typically, when you have those two overbought readings in near succession, especially when you've had the RSI come back to at or near the 50 level, that's when you usually get your sharp corrections. Let's look at it here. We had prices overbought this whole time period here. If you follow down here where the crosshairs are, we pulled back, hit the 50 level, punched up and to right here, got overbought, and then just remember, we're looking at a daily time frame, so just a few candlesticks later, a week or so, we began one of the sharpest corrections that we've had in years, from there all the way down into the June lows. So again, let's look for that pattern. Here we had prices overbought for a while, and if you follow the crosshairs up, the market just kept chugging along. Didn't, had a little bit of a one day sell-off there, kept pushing up as the RSI came back down to 50, pushed back up again above that overbought level, and then boom, that's when it hit. We had a very sharp one-day sell-off, another down day, prices came up, and look at that correction from this point here all the way down to here. And again, that followed that double tap reading. So something I've noticed on some of the different indices, I just wanted to point that out here because that's what we're looking at right now. And jumping over to the weekly time frame, now we're looking at a bigger wedge pattern. I showed you a smaller wedge on the daily, but this is the big wedge pattern, the one that I'm watching. Again, the weekly charts are what's really driving my positioning right now as I'm swing trading, giving my stops room, being patient on this. And this is a pretty well-defined large rising wedge pattern. And we have a slight overthrow on the wedge right here. And if you look just like on the daily charts, we have clear negative divergence. We had such a low reading on the MACD back in 09. Again, it almost skews it, but if you pick this up, you can see we have lower lows, negative divergence. Again, these are things that I covered a few weeks ago in the video, and nothing has changed there. Yes, the RSI did come above. A few weeks ago, I would have had this drawn down here. The RSI made a new high. However, it's still diverging. It's still yet to exceed the high that it made back here when prices peaked out. So negative divergence continues across the board. Once again, a reason that I'm leaning towards this being a bull trap fake out move that we've seen lately on the daily charts, especially if we fail here at the weeklies. And if we don't, if prices remain above these breakout levels, consolidate, work off these overbought conditions, and this down below, these readings, the oscillators change, well, then we'll be looking at a bullish market for the next few months going forward. But as of now, that's not the case. One thing I wanted to mention too, these trend lines I've shown before. I covered these in the last video, and I touched on this a little bit here. These are Fibonacci fan lines, and these were trend lines that I had drawn. I have not tweaked these in months. This is the yellow is obviously the primary trend line that I'm watching at this point in time. As you can see, the market goes up, follows these trend lines. We have these impulsive breakdowns. Again, all this stuff was covered in the last market update on August 4th. And if you look how beautifully these Fibonacci fans, I cannot edit these. I can drag them and move them, but they fill in perfectly or nearly perfectly with the current trend lines that we've had here in the market for the last few weeks. So I find that a little bit more than coincidental. So again, very important level here. If prices were to fall back, in the next few weeks and come back to this level, this would be the line in the sand for the bulls. If we break below these trend lines, both these Fibonacci fans, oops, took that one away, and or the way I have those drawn here, key levels to watch. Okay, quickly take a look at the Bollinger Bands. We're still on the weekly chart here, the S&P. Recently I pointed out that on the daily chart we had the Bollinger Bands pinched as tight as they'd been in years, and we'd get a big move out of that, which we did. The big move was to the upside. Unfortunately for me, and I know some others out there, I was positioned primarily on the short side. However, here's a pattern that I noticed, something I just wanted to point out real quick. If you look at currently what happened, we were a lot of bulls, and at most points in time it's considered bullish when prices are at the riding the top of the Bollinger Bands. If you look here, this is off the 2009 lows. Prices hit the top of the Bollinger Bands and just rode up the top for months. Again, did it here. Fell back, hit the top of the Bollinger Bands, rode the top of the Bollinger Bands for a long time. Did it again here, and that's common. Now let's see, and that also happened back in the last bull market. However, what I noticed at the top of the last bull market, this was the peak. I'm going to put the crosshairs on the peak right here. We had the Bollinger Bands, prices riding the top of the Bollinger Bands, had a sharp move down to pierce the bottom of the Bollinger Bands. If you can see here, there's a red candlestick tail down there. So prices sharply came down, kissed the bottom, bounced back up almost immediately, a sharp move back to the top, and that was it. We did not stay there long. Prices stayed there for looks like a week or two, and then that's all she wrote. That was the beginning of the worst bear market that we've had pretty much since the Great Depression, and that seems to be the current pattern. Now again, I can't predict the future. Prices could continue to ride up. This is something else I'll be looking for. This is another reason that I think the sooner prices turn down, the better it is for the bear case, and I'm not going to give it more than just a few weeks here. But again, we had prices riding up. We had that very sharp move down, pierced the bottom of the weekly Bollinger Band. I know it might be hard to see on this chart. Zoom in a little bit. There's the pierce. If we've shot up now, hit the top of the Bollinger Band, we've actually pierced the upside, and now I'm looking, for potential impulsive move lower. Okay guys, in the essence of time, I'm going to wrap this up quickly in these last couple charts. I won't spend a lot of time. Same story on the rest of the U.S. indices here. Here's the Nasdaq Composite. MACD, RSI clearly diverging. Yes, we've broken out to new highs, but not by a whole lot. And as I said, these divergences are significant. We're not talking short-term, 60-minute time frame. These are daily. And if we take a look at the weekly, here's a big rising wedge on the weekly time frames with negative divergences in place below. More flat line here on the MACD, definitely downsloping on the RSI. The NDX, Nasdaq 100, big bullish rising wedge, negative divergences. And this one you have a little shorter term divergence. If you look here, the MACD is sloping down and the RSI really double divergence there, and prices from this point to this have made a new high. So I won't go through all the equal weighted indices. We did that last time. Just look at it real quick. Same pattern. prices have not broken out to a new high yet on the equal weighted Nasdaq. We talked about that. Apple has been carrying this market, but I think that has probably come to an end here soon. So to wrap it up, in a nutshell, here's my take. Nearly all the key global indices have recently broken out to new highs and or above well-defined resistance levels, and that's clearly a bullish technical event. However, all of the key indices are either at or right up or slightly above very important key resistance levels, downtrend lines on the longer term time frames. That's weekly and monthly charts. Now, from my experience and observations over the years, the majority of market participants focus solely or really primarily on the daily time frame charts. Think about what the charts you see put up on CNBC or Bloomberg. They're almost always looking at daily charts. And by market participants, I'm referring to mom and pop investors, inexperienced traders, and even a lot of professional portfolio managers who are primarily employ fundamentally driven, portfolio security selection and asset allocation strategies. A lot of those folks look at the S&P making new highs on a daily time frame as being very bullish, but they're not eyeing these longer term charts. So that's why I think that all the ingredients are in place for a nice, powerful bull trap. Again, if it plays out, and if it doesn't, we're going to have to react. For those of you who are short, and for those of you who are unsure, best to be on the sidelines. Let's see. So I think like I said, the odds of a bull trap are still quite elevated right now, and in the next couple days to a few weeks here, we should have some clarity on how this thing's going to play out going forward. So, alright guys, hope you enjoyed the video, and as always, I'll try to keep these shorter next time. We're just at the just past the half-hour mark here. Have a great week.